The US stock market is in great trouble, and I fundamentally believe that there's only one thing that can save it. The AI narrative is out of control. Inflation is high, yields are high, interest rates are high, the list goes on. There are so many metrics screaming the US stock market should not be making all-time highs. Now in this video, I'm going to break down exactly what that is and the only thing that could possibly save the US stock market. Now, to get an understanding of the trigger behind a lot of the crashes we have seen historically within the US stock market, we have to look at this chart. So this is the S&P 500 on a monthly time frame, and it becomes crystal clear what the number one trigger for a massive crash has been historically. And yeah, you got it right. That is rate hikes. So let's have a look at the historical impact of rate hikes within the US stock market. So dating all the way back to 1929, when we of course saw a massive crash within the S&P 500. Now there were numerous reasons why this stock market was incredibly overvalued and why this was a pretty much an imminent crash. But what's important was the trigger that actually caused that crash, which again happened to be rate hikes. Now, in case you're confused, a rate hike is when the US Federal Reserve decides to hike the interest rates rather than leave them unchanged or cut them. If they do that at the wrong time, well, then that can cause exactly what we've been seeing within the market. And there is a strong chance that that's going to happen this year. Now, again, this has happened in the 60s. We saw it again in the late 60s, in the 70s. We saw it in 1987, the famous or infamous dot-com crash in the year 2000. We saw it in 2018, 2022, and again, it is potential or probable that we're going to see it again this year. Now, you've been seeing a lot of people compare what we're seeing now to the year 2000, right? The dot-com crash and the AI bubble seems to have a lot of correlation, and a lot of people are afraid that we're going to see the exact same thing. And I want to make it clear that they're not too far off. So the main reason why the stock market was rallying so, aggressively in the year 2000 was because the majority of companies with .com in their name was in fact incredibly overvalued. Now, they also got billions of dollars allocated to them with absolutely no future proof of concept, no business plan, no revenue, basically nothing but billions of dollars. Now, of course, what caused the massive crash we all know as the .com crash was in fact a rate hike. Now, no, a rate hike cannot be responsible for such an immense crash within the largest index worldwide. That's just not realistic. But what it can do is trigger the inevitable. So, for example, in the year 2000, it was pretty much inevitable that we were going to see a crash, but something has to trigger that selling. And 9 times out of 10, that just happens to be rate hikes. You see, when the US Federal Reserve decides to hike the interest rates, well, then automatically money becomes more expensive. What typically also happens is the yields, move higher alongside rate hikes, and the cash or the dollar, gets a lot stronger. And so when you have yields paying right now 5% and a strong dollar, well, then investors, institutions, and largely liquid traders will look at that and say, okay, well, I can buy bonds and claim 5% pretty much risk-free, and I can hold cash and pretty much outperform the stock market for free. And so naturally, people are going to do that. And so when you look at it like that, what we saw in the year 2000 is actually painfully similar to what we're seeing now, and we'll get more into that later in this video. Now, here is the thing, big tech, right? The large companies, the large AI companies holding up the entire stock market will spend nearly $700 billion on AI this year. Now, here's the key sentence. No one knows where the build out ends. And that right there is dangerous and awfully similar to what we saw in the year 2000. Billions, hundreds of billions of dollars being spent on companies with .com in their name, and nobody knew where the build out was actually going to end or what the outcome of these companies would even be. Now, this is hard for people to fathom because they just haven't seen it since the year 2000, and that's because you're not looking beneath the surface, because we've already gotten proof that this AI narrative or AI bubble can in fact crack. So June 3rd, which was last month, we got proof of exactly this. And what I mean by that is high expectations reflecting negatively onto certain stocks. And again, if they happen to affect the wrong stocks, well, then that can bring down the entire US stock market. This time around, it was the chip maker Broadcom. So again, they missed Wall Street's expectations for second quarter revenue on Wednesday. This is again last month. And again, the revenue for Broadcom was $22.19 billion, and they missed estimates of 22.27 billion. And so again, they were really close, but they slightly missed expectations because again, investors have ridiculous expectations regarding AI companies. And as a result of that, Broadcom crashed over 20% in a singular session, and since then is down nearly 30%. Now, in case you don't know Broadcom, it is not a small company, so 30% is extreme. Okay, right now, even after the crash, it has a market cap of 1.7 trillion US dollars. And this, in fact, makes Broadcom the world's 8th most valuable company by market cap, according to our data. So again, by market cap, this is the 8th largest company globally. So if a company, which is one of the largest ones in the world, can crash 20% in a singular session because expectations were just missed, slightly, what do you think happens if this happens to, the big five holding up the entire US stock market? It's going to get ugly. And I want to make it very clear that it's not just Broadcom who is being priced for perfection. In fact, we're seeing it happen right now with Tesla. So Tesla is at this moment trading at $393, and it has a staggering PE ratio of 360. This is absolutely and utterly ridiculous. Tesla's revenue for fiscal year 2025 was $94.8 billion, and in fact, a 3% decrease from the $97.6 billion reported in 2024. So they in fact sold less vehicles in 2025 relative to 2024. Now, if we then compare that to another major automotive company, again, Toyota, they reported record sales revenues of approximately $323 billion in the same fiscal year 2025. Yet Tesla has a much larger PE ratio relative to Toyota. It's not even close. So we're looking at a company who is getting outperformed by pretty much every single competitor and is in fact continuing to show weaker and weaker numbers year after year, yet it is being treated as if it is doing Toyota's revenue times 5. How does that make any sense? Well, it makes sense because Tesla is now being priced as an AI company, even though they have in no shape or form done anything within the AI sector just yet. And so what do you think happens to an asset or a stock like Tesla who has, just immense expectations regarding physical AI if they end up failing? Well, again, that is going to be extremely ugly. And Tesla is not the only one. We can also have a look at Palantir, which has a PE ratio right now of 145, which also relative to Palantir is extremely high. So again, a stock being priced in for perfection, and by the way, is down nearly 49% from its high in November of 2025. What do you think happens if Palantir does not fulfill the expectations of its investors? Well, luckily for us, Broadcom has already proved exactly what's going to happen to these companies if they in fact fail to meet the expectations of investors, only it will likely be a lot more aggressive. Now, here is the scary part. Let's have a look at the SPX 2-year normalized return, so including all the AI stocks, and then compare that to the SPX return had we not seen any AI stocks. So the 2-year normalized return with all the AI stocks is about 42%. Now, if we then remove the AI stocks, well, then it's only up about 16%. Now, I want to make it very clear that the S&P 500 has completely ignored the war risk premium due to all these AI stocks. And so had you taken them out of the equation, well, then this would probably not even be 16%. It would likely be closer to break even or even negative. So we're looking at a market that's up 42% on a 2-year basis, which would otherwise have been probably negative had it not been for just a handful of stocks. Right now, a lot of those stocks are being priced in for perfection. And so what do you think happens if all of them simultaneously disappoint investors and they are in fact the only reason why the stock market is up so much? Well, again, it is going to correct and it's going to get very ugly. Now, here is the part that bogs my mind, because in order for such a massive crash to take place, people need a reason to sell. Right now, they haven't had that. You see, in modern day finance, the vast majority of moves that happen within the market is controlled by algorithms. Now, these algorithms typically buy up stocks whenever they hit an all-time high, and that is often why you in fact see massive rallies following all-time high breaks, because again, that's when all the algorithms start buying up that stock or index. And so algorithms is one of the reasons why the US stock market has been able to just continue rallying, because, they create a lot of buy pressure. Now, once this US stock market stops making all-time highs, well, then the algorithms, in fact, do the opposite. And let me show you exactly what's dangerous here. The inflation is at this time sitting at 4.2%. The US unemployment rate is also sitting at 4.2%, which is pretty good, right? An unemployment rate of 4.2%, zooming out on a 10-year scale, is within healthy ranges. We also have the initial jobless claims, which is sitting at 215,000. And if we zoom out to a 5-year scale, well, then you can see that this is also within healthy parameters. So we are in fact seeing a pretty healthy, job market within the US and a pretty good standing economy as a whole. And so when you have inflation sitting at 4.2% and an economy that's doing pretty well and seemingly, a job market that's improving, well, then it becomes irresponsible and almost impossible to cut rates. It just doesn't make sense to cut rates into an economy that's already strong and already has an inflation rate of 4.2%. And so because of this, the US Federal Reserve is expected to decide on rate hikes in 4 weeks, according to Warsh himself. Now, when it comes to monetary policy, well, then Warsh is also historically hawkish, which again favors the rate hike narrative. And I believe the market at this time is pricing in between a 50 to 80% chance of an actual rate hike this year. Now, again, we've already established exactly what that has typically meant for the US stock market. And given all the different metrics we've just gone over, that could in fact be the one trigger it needs in order for that aggressive selling to take place. That could be the catalyst that starts a massive correction within the US stock market. And again, pretty much every metric is screaming for exactly this. Now, rate hikes alone would be terrible for the US stock market, but there's one more metric that makes this even worse. You see, yields at this time has gone up recently, right? In fact, we topped in this year at pretty much 5.2%, which is the highest levels we've seen since 2007. They are now headed right back into that 5% range, and this is immensely bad for the US stock market. What's even worse is rate hikes, because they in fact increase the yields even further. And so we are essentially looking at a massive bearish catalyst for the US stock market if they do in fact hike the rates. And again, that would be terrible on its own, but given the fact that yields are already, severely elevated, that just makes it, 1,000 times worse. The AI narrative has been able to ignore these metrics being severely elevated because it's just been so strong. It's pretty much acted as a shield, but a rate hike could change all of that entirely, and we could be facing an actual crisis. But something just happened that could in fact change this entire narrative later this year. You see, as of recently, oil prices have in fact started coming down. So when the US-Iran headlines first got out, well, then again, oil jumped up, like crazy, right? We exploded about 100%, peaked at $120 a barrel, and it was incredibly inflationary. And so again, that's the primary reason why inflation is now sitting at 4.2%, and they of course can't start cutting rates into such a high inflation. The good news, though, is the fact that oil, following a very specific headline, has now come down over 40% since its high and is now trading close to $70 a barrel. Now, $70 a barrel is in fact back within healthy parameters and actually back to pre-war levels. We ideally want to keep oil below $80 a barrel, and right now, well, again, that's the case. This will, however, take months to reflect on the actual inflation rate because we need to see a reflection of the lower oil prices within the CPI reports. So the bullish case for this year is in fact the lower oil prices showing up within the CPI reports, and of course, inflation therefore going down. What we really need is for the US Federal Reserve to move away from rate hikes and start pricing in a potential rate cut. Now, in order for that to happen, well, then of course we need inflation to come down, which is already, a probable outcome later this year given the lower oil prices. Secondly, we need the job market to start weakening, and I have good news. So recently we got a new NFP report which came in at just 57,000. So when you actually look at the one metric that sums up the entire job market, well, then you can see that it has essentially been going down since March. So we need something that will in fact continue this downtrend within the job market, because again, that would just make it way less probable that we see a rate hike this year, and again, could potentially start moving towards a rate cut. Now, let me tell you this. Right? Inflation at 4.2%, but the interest rates are also sitting at 3.75%. So right now we're looking at a weakening job market with interest rates elevated at 3.75%. And the longer these stay elevated, the higher the chances of that affecting the job market negatively become. And so if they start hiking the rates now, it will in fact, of course, raise the interest rates, which would make or put even more pressure on the US job market. Secondly, on a 5-year basis, you can also see just how low the actual consumer confidence is, sitting at 49.5 points. This is, of course, relevant because these are the people that make the actual money go around, the economy floating, and so on. And so when when their confidence is extremely low, well, then they're, not going to spend any money. And so if this continues to go down, it would all of a sudden make sense to cut the rates, because that would make money cheaper and almost certainly boost the consumer sentiment. And if the job market keeps, deteriorating like it's doing right now, which it probably will if the rates continue to stay high, and if inflation follows the oil prices, which is almost inevitable, well, then suddenly rate hikes become irresponsible and not rate cuts. So that right there, ladies and gentlemen, is the bullish case for this year. The Federal Reserve moving away from a rate hike and discussing a potential rate cut. That is what determines the next direction for the S&P 500, whether we go up or down. But again, it is going to take months because we need those CPI reports to start rolling in. So those are my thoughts regarding the US stock market right now. We are in a make it or break it moment, and what we discussed in this video is exactly what makes or breaks whether the stock market continues its rally or if we have a massive correction. So again, you can agree or disagree with my theory. I respect your opinion nonetheless. This was mine, and I hope you enjoyed. Now, if you did, please like the video and subscribe to the channel. This is a brand new channel, and I appreciate every little bit of engagement. Now, again, I appreciate every single one of you, and I hope to see you within our next video.